The major averages off session highs ahead of a key Fed decision on interest rates. That comes Wednesday. We'll be there for it. While the Fed is widely expected to hold rates steady, our next guest says he thinks we could see a surprise rate hike. Here on set, Greg Branch, managing partner at Veritas Financial Group and a CNBC contributor. Greg, welcome. Explain your argument here, because you're pretty much alone.
I am pretty much alone. I've been pretty much alone for probably a few months now, Tyler, so the feeling is not a new one. I think that when we look at all the data, there are troubling signs about inflation. And, you know, for the last few months, I have been hearkening that we haven't actually really seen much disinflation. So
it hasn't been subdued.
It hasn't been subdued.
Inflation.
And we are still counting the wins that we scored last year and several months ago as inflation is continuing to go down, as we're continuing to experience disinflation. And that's just not the case. Core has been going up 30 to 40 basis points since October. We had 2 months of reprieve from that in June and July, but now we're back at 30 basis points. And when you look at the underlying metrics, only electricity, used cars, and airfares declined more than 70 basis points. And we have to wonder when the runway for that, with the strikes, with the fuel, with energy costs, when that runway will run out as well. And so we haven't been seeing much in disinflation to begin with. We were lapping the base effect from last year, these huge numbers from June and July. That runway is going to run out. We are seeing across the board in various industries, as you guys just covered, other costs of capital for businesses. And so I think that with the PPI we just saw, with the uptick in inflation the last couple of months, with still record low jobless claims and still record low unemployment, that the Fed may very well be moved to do another 25 basis points.
And do you expect that this meeting or in November, or does it matter?
Both. On the one hand, I do, you know, if I had to place odds, I would say this meeting. Now, remember, Tyler, my terminal rate is 6.25.
This would get us close to there.
It would get us close to there. I mean, we're probably closer than most thought we would be to begin with. Mm-hmm. When I made that forecast a year ago, many called it alarmist or ludicrous and other choice adjectives. But you know, we're within reaching distance now of it. But to your other point, I'm not sure it really matters. At the end of the day, with a 525 basis point raise already, does another 25, does another 100 to my terminal rate target, is that what makes the difference? Or is it that we haven't felt the full impact of the 525 that they've already done?
I mean, I could go way out there and say, what if maybe they should be cutting rates right now? Yeah, that's right. I could tell you a story in which all of a sudden, you know, you get to Q4, maybe Q1 of next year, the economy starts weakening, everything's falling apart. Right. People's heads are falling. No, and you look back and you say, you know, there's supposed to be a leading body. All the leading indicators are terrible and have been. The yield curve's been inverted. All the rest is, and we're just waiting for the full effect to come. Right. So if they were to go off of what could happen in 6 months' time, it might tell you something very different than kind of what's happened for the past 6 months.
I would say that you're making a non-consensus argument with that case as well, though,
yeah.
Kelly. When I'm on these shows frequently, I've had other guests say that we've reached a trough in earnings. And so I'm not sure that the consensus view is that the macro environment's going to be that difficult. I'm not sure.
No, it's not. I'm just saying, you know, that if you were sort of say, hey, I think they should keep hiking. I mean, there is an argument to be made that actually policy is already too tight right now. Yeah, we could make that argument, certainly. What I think, though, just based on the conversations that I hear you guys have and that I have, is that I'm actually probably a little bit more dour on the consumer and the macro environment for businesses than most. And so I have a hard time reconciling that with rate cuts, certainly for this year, which we talked about all at the beginning of this year, and even into next. I doubt that we get rate cuts next year.